Hello and welcome everyone. This is Spectre Trader, and today we're going to talk about trading psychology and how it applies to your trading. I think it's a very important topic to discuss because I've seen many beginning traders or even like advanced traders struggle with psychology because mentality is really a huge integral part of trading. I mean, you could have a great strategy, but if you don't have the right mindset going into your trades, it could truly mess up your profit and loss for sure. So the first point I have is one of the reasons why traders tend to lose a lot is simply because they don't have an edge. And what I mean by that is when someone doesn't have an edge, one instance of not having trading without an edge is when I've seen a lot of traders, especially beginning traders, they tend to overtrade on really subpar setups. They would see the price action on the chart, and they'll through their bias they will conjure up um a trade idea which may or may not be legitimate, and that tends to make people jump into trades, usually because they have FOMO or the fear of missing out, or sometimes they really just trading on tilt, because they lost money and then they get emotionally biased. So they tend to sort of let their bias get a hold of them, and with that, they take really bad setups, or they throw out all the rules and the parameters they look for in a setup, and they take a more, let's just say, lower odds setup. So it's basically like, if you do this, it's basically like gambling, because instead of having the same strict discipline and having the same amount of the probability of winning that you may have back tested in a strategy prior, you may just deviate from that completely and just absolutely skew the statistics. And this usually happens when most traders, they take a big loss, so they get into this mindset where they they feel like they have to make it back. So they start taking these small trades, like here, like a quick scalp here, a quick scalp there. But it's because with that, they tend to get very scared because they just took a big loss, and then now they're afraid to take bigger losses. So what happens is they actually take profit when they take profit too early, when they're able to actually secure a bigger profit target. And they tend to panic whenever they see a stall on price action, or they're just purely impatient. So what essentially happens is they tend to scalp quite too much, and they end up getting wrecked by that anomaly. You might have a high win rate scalping, but eventually, and if you when you're super biased and you keep taking the same scalp on a very key level, eventually that key level is going to break. What happens is, once that level breaks and they get too biased and they refuse to stop out, they end up getting wrecked by the bigger loss, and it wipes away all the gains again. Now that goes to my next point. Really, is that people tend to start scalping without like a strong plan. And don't get me wrong, you could scalp. Some people scalp as a trading strategy, but I've seen a lot of beginners get into a scalp mindset because they're afraid of losing, and I mean, they don't even really know what a good setup is for scalping. They just simply take the trade and they pray and hope that momentum is on their side. So, they just take the trade and they're just sitting there and they're just hoping. They're not really looking at the order flow, or even if we're at a key level, you won't be scalping just right in the middle of just nowhere, because that's very risky. If you're taking a scalp without any key levels like that, you could easily just get hammered. Like your risk reward ratio would just get absolutely destroyed. And this also happens because I've seen a lot of traders, especially beginning traders, get into the scalp mindset, is because they're sitting there in front of the computer or in front of the trading screen, and they get bored, and they take trades out of impatience. And that's a really really bad mindset, because sometimes the market does not give you the perfect opportunity, or just sometimes the opportunity is very very minimal in certain environments, and oftentimes people get trapped in chop, or they tend to get very biased and get stuck in a position, and it's a very nasty cycle, really. So I really emphasize when the market is slow, it's always good to just be able to sit on your hands, and or just walk away from the screen, because otherwise, you'll get bored, and then you start getting into this vicious cycle, and you end up taking unnecessary risk. Because the idea is not just to make money is very important, but what's very important also, a very key principle in trading, is really being able to preserve your capital too. Now, my next point that I see as very common is a very, very key element, I would say, that causes many traders to fail, is because of certain psychological barriers like fear. And it's oftentimes that it's because they're afraid to lose. And when they hesitate in the current moment, and when it's time to like execute their setup or play, they they have this over gripping fear that causes them, like it's like when a deer is caught in front of headlights, it is freeze, right? So when it's time to go into action, they fail to execute in time, and they end up missing their trade. And this, and don't get me wrong, missing your trade really sucks. So this actually psychologically messes with a lot of people, and when that happens, more often than not, a lot of people decide to take a less favorable trade because they missed that initial setup. Then you get into this mindset where they have this grief of missing out, really. So they get overly biased, and they end up getting emotional, and then they end up taking a bad trade, and that's when many traders actually get destroyed. So I think, like I said, patience and also being able to take initiative at certain times is very, very important. It's a very fine balance, really. And I mean, like, for example, like people could see a potential trend set up, and when that certain setup occurs and you don't take it early, and you start regretting it. You see the market take off without you. The market is up 60 handles, and you're just you're kicking yourself, really. Just you're wishing that you could have taken that trade. And what happens is, like, this this grief of missing out, like I talked about before. You tend to. I've seen many people, they end up chasing it towards the very end, when the whole market move has already occurred, and they end up getting a very horrible trade location because they chase the market. Like for example, you could have like bought a stock at like $100, right? And you see the setup, you miss it, and it starts going up, and you're like, oh, I don't want to pay up for it. It's too high. Then it keeps going up, goes to like 110, and you just FOMO in, right? Because you see a little dip, you FOMO in, and you think, oh, maybe I could maybe get like a quick little scalp or a quick little this. But little do you know that the ATR is actually $10. End up buying at the max ATR, and that's, I mean, it's a very, even if you do make money, it's a very bad to have. Because just because you're successful in the past does not necessarily mean that you'll have future success. It's really, you got to take a whole data set and be able to analyze that data set and see, okay, in the long run, is this strategy profitable? Is it, how much drawdown am I taking? Is this a very sustainable way of trading, or is this some sort of temporary success? And I think that people really, especially retail traders, I think they really fail to understand this concept and apply it to their trading. And yeah, I mean, you just never want to chase a market, especially when you miss the move, is because you end up taking more risk than you need to. And more often than not, I mean, even if you're right, even if you're right in the current moment, most of the time you'll probably get caught in some chop, or you come late to the party, and then the move is already exhausted. You have all the momentum already gone because the move already happened, and then it pulls back on you. So it's not really just about being right, but it's also about being able to sort of get the right timing and being able to have patience and initiative. Now, on the opposite end of the spectrum, you actually have traders who not only have like a fear to take initiative, but, and I talked about this before, but FOMO, I think, is a major killer trading, because you have these guys, just these traders, guys and girls, looking at a screen, looking at the price action of a chart, and then they start seeing very high volatility, big price movements, big spike up, and that's a very dangerous thing if you fall into FOMO, because I mean that's just one way to get trapped, really, because everyone, they see a move like happening, and they get this instinct to start to chase it. And I think that's a very dangerous way to think, because you end up throwing away all your discipline if you FOMO in. You get very emotional, you lose all your discipline and all the parameters that you've been looking out for. You just ignore it all, and you just simply chase it on impulse. And I think that's a very dangerous way to trade too, because you tend to lose like all sense of logic and reasoning. But yeah, anyways, the next one is sorry, the slides are kind of messed up. Yeah, so my advice is, it's very important to be very disciplined and being able to stick to your plan, because really, in the end of the day, you can have all these emotions, and it is very tough being unemotional and logical in the market. But you gotta formulate a very hard coded plan and like ingrain it in your mind, because if you're just trading off of emotion, you're not really thinking very clearly about it. You really don't have an edge. You're really just part of the 99%, the 95% or the 99% of retail traders that end up really losing money in the long run. Because I mean, that's how the market works. Really, it's a game. You know, most most traders, they tend to lose, and there's like a very small percentage of people who actually win. And the reason why the small percentage of people actually win is because they have an edge over everybody else. If you do everything, if you do the same thing that everybody else does, it's the same thing that not the 95% do. Really, do you? I mean, you're not going to make money. I mean, there's research that actually shows that this statistics is actually true. So now, how to become, how to have that edge over everybody else is really, I think, a very big part of it goes down to psychology. Now, another thing I think is very important is that, sorry, this is not in the slides, but another thing that's very, very important, and I think that's a very key principle, is when you have a losing position, and when you see every single sign from the market telling you that this trade is a bad trade, you see you see all these key levels being broken, but yet you're very stubborn. You don't want to take a loss. I think that's a very dangerous mindset too, because you have some people who are afraid to take the trades, or afraid to stay in the trade for long. But then you have these people who are too stubborn to take a loss, and they end up taking unnecessary drawdown and extreme risk. Instead of managing the risk and keeping the risk tight, they just place a huge stop loss and average down, when the broader, the big picture is telling them, like, this is a complete, this is a bad trade. Let's just say you're long a stock and you see a breakdown of a very key level, and this is like a pretty nice correction. That doesn't mean you want to be adding down to lower levels, because what if this is some sort of bigger fundamental breakdown? Then you're really just digging yourself in a bigger hole. It's not really about taking, it's not really about winning every single time. You can't look at things trade by trade. I think that's a very dangerous mindset. I mean, not everybody could win like every single time. And anyone who tells you they win and make money every single trade is full of BS. And it's really a long-term game. You got to be able to take this data set that you have from your strategy back testing, or over years of data you could take, and you could analyze the data and see, okay, is this strategy, is this a good strategy? Am I doing this correctly? Is my win rate higher than my losing rate, or what's my risk reward? And if you're not able to discern and be able to really really separate yourself from this very narrow mindset, I think it's going to be very tough for you to get into to stay in the business. And don't get me wrong, this business is very, very difficult. I mean, you see last year, 2020, where everyone's making money. That was easy. But once I think a lot of people don't realize is once the market gets really choppy or you get into a bear market, it gets very, very difficult. And there's no such thing as easy money because there's always different types of markets and certain strategies don't always work in certain markets. So it's very important to pay attention to context as well. Now, one thing that I actually emphasize in my trading is being able to capitalize on psychological levels in the market. And what that means is that you're able to sort of think a few steps ahead of everybody else. You look at these certain price levels and you see, okay, you have some buyers at, here's an example actually on the ES. So yeah, let's just say you have some buyers at this support level and they think, okay, this is a key support, blah blah blah. You could actually, we, if we hold this support, we might be able to push back up, blah blah blah. But we're breaking down. Now, the idea is, you know that a lot of people are getting positioned at this current level, and if this level were to break down, then you would have a lot of bag holders here, and you'll have some stops being taken out. So what you could do actually is you could actually play this on a short side. If we had a breakdown of this level, that would, you could actually go short. And what happens is, if we have a breakdown of this level, you have all guys with their stop losses. These short-term traders, mind you, these are not long-term investors. These are short-term traders. Very fickle, very fickle, weak hands, I would say. So the idea is like these guys will all get trapped here, and you short it, and you could write it down, the momentum down, and get a pretty nice fade. But also, what you could do is actually you could wait for this level to get emotional. Wait for these stops to get hit. You have these emotional sellers sell off, and what you could do is actually you could fade them once watching the order flow. Of course, you don't want to just jump into it, but you want to look at the order. Okay, when is the selling sort of lighten up, and when is the panic? When has the panic settled? And once this panic starts settling, you could actually enter a fade, because if the idea is this is just people getting stopped out, and the way the market works is if you have a bunch of stop outs, it's not real selling. It's not institutional sellers. These are just short term guys panicking and selling. And the idea is eventually the market to its mean. So that's one strategy that you could use using psychology in order to capitalize on markets. And yeah, the idea is you see on the first test of support we had a bounce, but the idea is we kept coming back to the support level and testing it, and you have these buyers keep trying to play this level. You have these short mindset guys playing this level, and if you're long, the idea is if you're not if the price is not going up, you're not getting paid. So the longer it takes, the more nervous you start to get. And if you have all these short-term guys and starting to sell, that's when you get some sort of breakdown like this. Now, another thing that I think is very important in trading is that you want to be very adaptable. You never want to you never want to be very stubborn. And I mean, mind you, you want to stick to your plan, but when you see the market telling you a different story, you want to be able to be flexible and adapt to it. Because let's just say you just you were to use co-integration with pairs, and this works in a very low volatility environment, but really when you get into high volatility, that's when you incur some big drawdown, and that's when you blow up. So mind you, you got to understand like the context of the market. Not every market, the market is always going to be evolving and changing, so you can't really be um, overly biased. I would say, you might have a big bull market and you think, okay, just buy the dip, right? Buying the dip is it works until it doesn't work. That's a very dangerous mindset to have too, because people, they see something work for months, right? But once you start seeing a trend change, buying a dip mentality is a very dangerous mentality because it doesn't work anymore. Once it starts getting choppy, you get chopped out. You have an algo driven market, and you just have the algos just keeping the range very tight. It's just a very nasty thing to get trapped in. And you got to always be ready for surprises, while you stick to your plan, of course. But it's a very dangerous thing really to just be very biased, because you could think something like a price. You could think the price of a stock is too high or too low, but that's a very deadly mistake. And sometimes you'll have you'll have the market sentiment value a stock at a higher price because a set of data that has come out into the market, into the public news space. And you got to be very wary and very adaptable to this, or you could end up getting hurt. And yeah, another thing is you can't think that every day is equal. And what I mean by that is you'll have certain situations where you'll have a trend day, you'll have a more consolidation type of day, and being able to identify some those types of days are very, very important, because if you're not able to realize, oh, like we have a lot of momentum to the upside, we're going to trend up, and you're thinking, oh, you have this really strong bias that, oh, we're probably going to be going sideways today and consolidating, and you keep shorting, thinking it's going to back to the revert back to the mean. But really you're failing to understand the whole context, and you end up getting that's I mean, that's one way that traders end up blowing up, is being too biased. And another thing is, yeah, the opposite thing is, you don't realize today is a consolidation day, and people end up trying to play breakout. They buy at the top of the range, thinking, "Oh, this is about time for this stock to break out." But it keeps testing the top of the range, it keeps failing, and it keeps falling back to the bottom of the range, and you end up getting stopped out, and it's a very vicious cycle. So I think that's a very important to understand. Another thing I think is very important is to be able to trade probability and not P&L. And what I mean by that is when you're trading, you don't necessarily want to look at your P&L because that could really mess up your mind and make you emotional. You see, let's just say you're long a stock and take some size, but then you take some heat. But if you look on like the daily chart, or if you look on your profile, we're actually holding a very key level. The big picture is fine, but you might be looking at P&L and you start panicking. So I think what a very good way to trade is actually not P&L, rather looking at probability and opportunities. And what I mean by that is you never want to let your P&L necessarily dictate how you handle a situation, you know? Because you never know, you might take some heat, but the idea is you end up actually making a pretty decent profit if you held that position and not panicked. And just a very dangerous mindset too is people have this very I see this very commonly. People have this very uh, dangerous mindset of thinking, okay, I got to make a certain amount of money every day. Okay, this is my goal, $500, $1,000, 10 grand, whatever. And that's a very dangerous thing because you end up pushing yourself when there's no real opportunity sometimes in the market. Sometimes you have a slow market, a very low tempo day. You want to just stay away. And if there's no opportunities and there's no edge, there's no taking risk on and losing your hard earned money. That's why I think it's very important to be able to identify these opportunities, being able to take these high probability setups and understanding like how to manage risk and take the initiative when you need to and when to be very patient. Because if you think about it, net profit and loss is not really a truth. It's a stochastic variable. So what I mean by this is you could have a strategy that you could take. You could have a profitable strategy and over a key over a data set, and each time the profit and loss will be different, but the probability, if you create a probability distribution of your profit and loss based off all the data sets, you'll be able to see the bigger picture and a longer term picture and see, okay, is in the long run, is this a sustainable strategy? Because you could have a strategy that you can fall on either side of the probability distribution, but you don't really know if it's profitable until you have the data, right? Because you have these you have people taking these trades and they think, okay, I've seen this before. It most it's going to go up, but that's just usually that's just a random chance, and it's only when you have a lot of data to support your idea through statistics is when you could actually see. I mean, you could understand like, okay, this is a very good strategy. You need to be able to game it out, and once you get in a big enough data set, then you would know that this is a good strategy and whether or not it's profitable. Because you like I emphasized before, future success is not determined by past successes. And yeah, I mean, just finishing up on this presentation really is you need to be able to be objective in the market and very unbiased. Because if you're not, if you're completely biased and you're just absolutely stubborn and narrow-minded, be able to make it in the long run in this business. It's a tough business. So what I really recommend is being able to separate yourself from your biases and being able to see the big picture and really really staying flexible in the market. Because when you need to adapt, you got to adapt. When you're when you have something that works, you need to be able to stick with it and take the initiative. So it's a really complicated but rewarding business that is trading. You just got to be able to differentiate the opportunities and be able to stay stay profitable in the long run. But yeah, that's pretty much it with the webinar. If you have any questions, let me know. I know this is kind of a impromptu sort of webinar that it ended up becoming, but I think I made my point pretty clear. So let me know if you have any questions. Alan, I'm finished, by the way. So